our discussion was around, is there anything that the Norwegian Sovereign Wealth Fund or the Canada Pension Plan or CalPERS or these huge funds can do to hedge their beta risk or diversify their beta risk with active allocations of any type? And I think we sort of concluded that the sheer scale of the hundreds of billions of dollars that they manage necessitates the allocation to just major cyclical beta risk, right? And so I think, we were saying, look,
I see the question.
Our
now.
strategy is not useful to the Norwegian Sovereign Wealth Fund because we can't run $500 billion trading at the frequency we trade. Right?
Sure.
So that's the context.
Yeah, I didn't capture that before. So yeah, at that size, I don't know if it's worth even thinking about, because also the sovereign wealth, they don't have investors they're answering to, right? For them, the market cracking is a chance to just buy more equities, right? So it's a completely different mindset. They're not answering to someone, and they want to just keep on putting money to work, right? It's the same as, there's many big institutions that are like that. That's not who we or all of this tail investing world is for. We are for people who are answering to investors that are managing pools of capital that have a lot of other strategies in them, which typically everything is subject to negative skew, is subject to market meltdowns, and so they need offsets because they have to answer and produce statements every month to their investor pool. So that's a different class of the market.
Thank you for reframing. You're totally right, and thank you. That's kind of where I was getting at. One of the interesting things that came away from that is that you really have these large pension plans that they can't, right? When I speak to the CIOs, they're like, "Listen, we can have a massive bleed, and then piss everybody off along the way to get some sort of hopeful tail protection if we get enough. If the counterparty risk that we sold the OTC from or bought the OTC from isn't going to blow up. So we just rather take beta, right? And what happens is you have these massive pension plans that are like the guardians of the way money should be managed. And you see the mid-sized pension plans and multifamily offices look to them and say, well, I need to be like them, right? Like that's their benchmark. And what we're trying to say to people is like, no, as you get smaller, you actually have tons more options. You actually can get that type of possibly, the holy grail that we were discussing, or alpha strategies that are truly,
you should be focused in areas of the market and strategies where those large pensions definitionally cannot go,
and
either regulatorily or. Yeah,
well, pensions don't use hedge like tail protection. Why should we? Well, because you're not a massive multi-billion-dollar hedge pension plan. You're
right.
Smaller, you can do a lot more.
Of course, but not just so pensions don't use them, but pensions also worry about their liabilities, right? So they don't have that, but they've had the benefit of a 20-year bull market.